Hi, welcome to the Market Alert for Monday the 9th May 2016. So Friday saw the non-farm payroll figures released into the market at 1:30 p.m. The market was fairly quiet beforehand, and here you can see the news being released into the market. You can see prices moving lower and trading down to the 17,550 level. And the reason for that is that the actual figures were forecast at 203,000 improvement. They came out at 160, so a good 43,000 less than the actual forecasted figure, and rightly so. The market moved lower but then found support, and the plunge protection team came in and moved the market higher. The market ran out of steam at 3:15, and we then see the market moving to the downside. We see prices just trading to the 20-point scalp there before then moving lower to the 17,600. But on this one, just taking the 20 points because again, given the fact that I keep saying that they want to keep this market moving to the upside, the market found support at this level. Didn't actually drive through until the third bar after the market hit the scalp there. So then we had a buy signal in the direction of the market wanting to move to the upside. As I've said before, you can see this time driving through the scalp, and when the market drives through the scalp line, we then look to trail the stop either 50 or 100% above the rising lows, and you can see here the market making these rising lows, and then we see just above the scalp there again as the market comes back for around 21 points. So let me just cancel the line there. And then in the evening we had another buy signal. Again, we see the market driving through the scalp, also driving through the 17,700, and when the market drives through with a big bar, as you see here, then we trail the stop under the rising lows in the buy, and we see the market stopping out at 17,000 to 17,721. And if you want to do just a quick calculation, you can use the measurement tool, which can be found under the tools option, and then click from here to where the market stopped. You can see there 32 points. So there we've got a good 73 points for Friday's trading session, which is great. Nice amount of volatility in the market as well, which is good to see there. We'll come to that in just a bit in a few minutes. So we've got a situation where the market pulled back on bad news. It was very, very bizarre. Selling taking place initially, and then you see the market being brought back there. I don't know whether there's much buying in this or not. It could be that we had selling beforehand that created the volume. Certainly the market going up steadily, so I suspect there's more selling volume in here than there is actually buying. So for tomorrow, let's just have a quick look at news tomorrow. In fact, there's absolutely no news tomorrow, so again, stand aside and watch and see what happens in the morning, and then we'll take a view from 2:30. What I mean stand aside is in the pre-market session, where we've had some decent moves of late. If you've traded any of these, then just make sure that you stand aside, stay out of the market, because there's won't be too much volatility around. Tuesday we've got Dudley out speaking, and Rosengren, never heard, and another one as well, George Speaks. Blimey, they're bringing out some Z-list FOMC members here to actually speak this week, so we've got three of them out. So it's sort of the Federal Reserve reality show continuing this week, as we've got not too much on the economic news front, as you can see there. And finally, volatility also dropping back below the 1251. For those of you that are new to the course, the implied volatility is the best measure of market direction and risk, and basically the options implied volatility is the yellow line, and this shows the risk that the option sellers are prepared to price in, and the blue line is the real historic volatility. What do they mean? In a nutshell, very simply this: if the yellow line goes lower, it means that the underlying market is moving to the upside. So here you can see the Dow's moved up from February over 2,000 points, and in the implied volatility, this has dropped down because there's less risk to the downside. So it's ever so simple. Stock market is going up if the yellow line is going down, and the blue line, of course. And then when the market starts to go down, you will see the risk increase in here. And how this works is very simple. When this gets down to the 10% area, that's the yellow line and the blue line, then the underlying market will start to correct, which is what we're seeing now. And this is exactly what happened last July and August, where we saw 1,000 points drop in the market before the market actually opened. And then we saw the plunge protection team, which was set up by Ronald Reagan, come into the market and then drive the market back to the upside. So very simple. It doesn't look as complicated as it appears. It's very simple. If the yellow and blue line are moving to the downside, that means that the Dow Jones, the underlying market, is moving to the upside, and then vice versa when the switch takes effect, which we've seen over the last few days. The sell in May and go away, which we've started to see unfold here, where we've got into May. You can see there the market moving to the downside. Expect a bit more weakness as we go forwards as well. Right, that's it for Monday. I will see you in Tuesday's edition unless I need to report in the meantime, but expect things to hot up as we go through May. And I don't mean the UK weather, which has been very nice, but the markets, as more uncertainty comes into them as we go forward towards the next 2 to 3 weeks and then into June. Right, that's it. I will see you in Tuesday's Market Alert. Have a great day. As ever, thank you for your support and also for watching. See you in the next one.